We're going to try to make this really interesting and fun. So basically, they have no idea what I'm going to ask them. We didn't coordinate or prep anything. There's no like, don't ask me this question. To give you, to give you your money's worth of entertainment. I think so. I'll just start. Introduce myself. I'm Lasse Clausen. I'm the founding partner of 1KX. We're a Berlin-based crypto fund, and we invest exclusively in open source tokenized networks. So we're kind of token maximalists. And then I would, maybe each of you please take around 2 minutes to introduce yourself, your fund, what do you do, maybe how are you special compared to other investors, or anything that's relevant.
Okay, cool. So I will come first. Sorry for my low voice, and so I got a really bad cold. I started like 2 days ago. Thanks for the air conditioning here in Hong Kong. Hi everybody, my name is Dovey. So I'm a founding partner of Primitive Ventures. We are a full stack crypto asset holding company. So I started my career back at eBay, but that's when I discovered Silk Road. So as a marketplace, because the marketplace might be the most primitive type of protocol design, because you have to design all this reputation system and just matching engine and stuff like that. And so during my eBay time as a product manager, and so I learned the skyrocketing sales number of Silk Road, and then that's how got my attention to to the whole crypto industry. And so I was born and raised just back in Guangzhou. So Hong Kong is my second hometown, and so I'm Cantonese. So I moved to US at the age of 20, and for my master's degree in Carnegie Mellon University. And then afterwards, and moved to San Francisco Bay Area, and then spent 4 years at eBay as a product manager. And just during my eBay time, other than discovering Silk Road, and then the other thing is, my mom is a typical Asian parent, and so she wants me to have property all over Bay Area. But it's extremely hard to move money out of mainland China, because we have this very strict capital control. It's that every people will, so every individual headcount can only move up to, can only transfer up to 50,000 US dollar every year. So my mom has been trying to ask 20 different relatives to move money out for me to buy houses. And then after I discovered Silk Road, and I basically convinced my mom to move to move money through Bitcoin. And then so it turned out I didn't use the money to buy a house, and I basically just let my Bitcoin just park there. And my mom now is pretty happy, because the very early down payment for a house in San Francisco now can pay for probably a lot of houses. So that is how I got into the whole industry. And then after that, I spent 4 years at Danhua Capital, DHVC, and I led the fintech marketplace and then blockchain investment there. And then late last year, so I basically started my own venture with my co-founder Eric Melter, and Primitive. So that is Primitive Ventures. So at Primitive, I think we are kind of different, and because we are more a holding company, so we can be extremely versatile, and we are not linked to specific, either equity or token or secure token or whatever. So we can do a lot of operational work as well. Say for instance, we can do staking as a service, and then we can even do in-house incubation and just doing spinning out. Because I think the crypto cycle has been squeezed from the traditional financial cycle is 8 years, and then so now we are probably 12 months as one cycle. So if your overall fund cycle gonna cover multiple macro cycle, and holding company gonna be a much better structure. Yeah, sorry for too long.
My name is Cindy Leow, and I'm the co-founder of 256 Ventures. We're an early stage investment fund, and we spun out initially of an arbitrage fund late 2017. because I guess me and my partner, we had similar skill sets more in the venture building and venture investments. So we were really interested in like pre-ICO bubble, looking at exploring that a bit more, looking at what was like driving the market at the time, and what like were there any like actual technological like, fundamentals that were worth exploring. So that was the reason that we initially spun out, and we've been operating for 1.5 years now. And so I guess what sets us apart from other crypto funds is that we have a very, very flexible mandate. We look really closely at crypto market cycles, and we invest more like both top-down and bottom-up like analysis. We have we can do like staking, we do equity investments as well as token investments, so we have a very flexible mandate to deliver on, I guess, a 2-year cycle. But I guess the special thing about us is that we're digital native investors, so we really look at it from the point of who is going to be the main like users of the products that we're investing in. So that's our main focus. And by way of background, I was previously in venture capital working in Korea and Shanghai.
Good morning. My name is Jehan Chu. I'm the co-founder and managing partner of Kenetic, based here in Hong Kong. We are an investment firm. We have been investing for the past 2.5 years in the blockchain space in everything from equities to token. And we have participated in advisory services as well as OTC, high-frequency trading, and structured products. And currently, those are our areas of focus. We're looking at investing across the board, but definitely with an emphasis on the equity side at the moment. Outside of Kenetic, and arguably more important, I am the founder of the Ethereum meetup here in Hong Kong. We were very happy to have a nice event last night, as well as co-founder of the Bitcoin Association here in Hong Kong, and then finally co-founder of Social Alpha Foundation, which is a charity dedicated to providing no-strings grants to projects using blockchain for social impact, which I think is an area we should all be kind of thinking a bit more about.
Yeah, thank you. Also, a side note about myself, so I'm also an investor. I'm one of the funds, so I'm going to be basically an extremely opinionated moderator that randomly is going to throw in sort of his own statement in there as well. So I think in 2014, 2015, we had a bunch of people kind of saying, yeah, blockchain, not Bitcoin. And I think a lot of them really kind of regretted that. It turned out to not probably be the best strategy. And my sense is that in 2019, we're seeing a lot of like equity, not tokens. And so my question is like, is that going to be the equivalent? Like, are there going to be a lot of people really, really regretting this in the future, or is it actually a sensible shift to equity investments? Do they have inherent advantages? Do traditional companies have inherent advantages over these sort of loosely structured tokenized networks? And whoever has the strongest opinion about this, feel free to jump in first.
Sure, I'll take the first swing at it. I mean, absolutely, we don't regret any of our activities in the token space. We were happy to kind of walk out with around 70% gains on our 2018 portfolio, which was pure token. At the same time, the end of that sentence about whether you're investing in equity or tokens is that for now, right, there are windows of opportunity for different types of assets, and especially in our field, that window is very dynamic. Just because we're focused on equity now doesn't mean that we won't continue looking at tokens and find the right entry points, and especially the right areas of kind of value and utility to back those tokens. I think that's really what's been kind of challenging, is to make sure and have the level of like de-risking your investment by having sufficient utility behind those networks, sufficient users. That's what's still kind of in play. Equity seems safer, more de-risked, because you have a better sense of like how to value those assets behind it. And then we'll see about security tokens, the types of good inventory that comes to market. But for sure, we're not backing away from tokens for good. It's just we think that there are really good opportunities in equity now. If we start seeing better opportunities in utility tokens, we'll look at those as well.
The way that we differentiate, I guess, like equity deals and more token open source network deals is the equity deals tend to have a stronger cash flow, and there's kind of a clear value accrual to a holding company, either a holding company or there is a revenue model that goes directly to one controlling party. And we've seen a lot of deals come up this year that are more in that realm. Okay, we're providing a developer tooling, and we're taking fees on top of that that help you gain access to to a more open source network that might be more difficult to navigate on your own. So kind of more servicing companies, software as a service companies as like an example of that. And on the token and equity, token side, I think. For us, what makes sense is more open source networks, and we haven't really seen a lot of smart contracts platforms being launched this year. So in that sense, I agree that there is also there's a different windows of opportunities for both. I think right now we're seeing more software developing tools as equity building to access these open source networks. But in the future, we might see more and more open source networks start to issue their own tokens again. But for us, the real question really is where does the value accrue? Where does the value accrue? Is it an equity investment in a holding company that's holding tokens, or is it an equity investment in a company that receives revenue from providing services, or is it buying tokens that give you access to cash flow for an open source network with decentralized providers, I would say, not a centralized provider. So that's the way that we kind of differentiate equity versus token investments.
Yeah, I think that from our perspective, if you're like a shitty project and making into equity doesn't make you more valuable, and so it's the same thing as during the last bubble, and a lot of just token. A lot of token projects, and so they basically just frame the whole story of having a token, and just for the purpose of only for the purpose of fundraising. And so I think if we just back to the basics and just looking at the fundamental, if you're equity company, what is equity? Equity is equity is the residual value of that specific organization, right? And so, if you cannot generate decent cash flow, and then how you can justify the value of your equity, and so a lot of projects right now just building XYZ for developer, and then whatever as a service, and so I've been looking at SaaS space for last 5 years, during my venture career. SaaS has a very standard range of PE ratio or just PS ratio, right? And it's a very standard valuation model. And if you're building a SaaS company, and then how you're gonna exit it, right? And so right now at Silicon Valley, the first investment from the ever first investment of a SaaS company, to either IPO or merger acquisition for any exit, took average 6 years, right? And are you really preparing for that? And so I think the fundamental question here is not about equity or token. That's just a value instrument, or just a vehicle that holds the potential potential value accumulation. And I think a more question here is and then where is the demand? Where is the demand coming from? And then just talking about equity, a lot of people has this interesting fantasize about there's a million developers out there, or probably tens of million, and then the scale of our industry is so small. So what I can tell you is the biggest application right now is trading, is exchanges, right? What is the DAU of Binance and then Huobi and OKES?
Is DAU the right metric, or is it value traded? Because there's this conversation where people
so there's volume, and so we can definitely talk about that. But if you are selling just equity, so I'm using developer tool and just software as a service, right? If you want to serve developer and serve just users out there, and just think about the broader user base, gonna be traders and speculators, and speculators and traders and exchanges at DAU right now is anywhere from the biggest one, right? The biggest at Binance, the Binance level, they are right now the DAU is 10,000 to 25,000, and it is definitely not internet scale. So I think if you're building for this whole ecosystem, you have to think about what is the scale and what is the unit economic, and then that's how you can price your service properly, and then that is how you can model your cash flow.
Yeah, my take is on it that it depends for what type of technology you're building and what structure. So if you're doing a layer 1 chain, I really think token is the only way to go in a sort of non-profit kind of organization. Imagine Vitalik said like, hey, I'm going to start charging 10% on the miners fees in the middle for me and my shareholders. Like, I don't think.
Don't forget Ripple.
Yeah, well, no, I wouldn't call Ripple really. Well, it's a nice edge case where they really shouldn't have a token, but somehow they have one and they keep selling it. But I think sort of if you're trustless computing sort of infrastructure open source, a token really is the only way to go. If you build developer tools, I really think equity is kind of the only way to go. You're going to be a very traditional company that's going to charge developers $100 a month to make development a little easier. I think you raise a valid point that if you're only targeting blockchain developers, your market at this moment is a little small. It might expand a lot. I think also what we're seeing, so a little bit the shift to equity was a little bit investor driven. I would say, so 2017 made you had a lot of new rich crypto money, and they were very happy to invest in other tokens. And so a lot of people said, hey, my cost of raising capital is actually drastically reduced. I'm going to try to raise money for something that's kind of out there, for a new layer 1 chain, etc. That really just has a token and it's very easy to raise money. Then sort of at some point after 2017, there weren't like a lot less new rich people, so I think that kind of easy sort of token money went away, and the majority of funding right now is VCs. A lot of them have LPAs, meaning that their agreement with their investors doesn't allow them even to buy tokens. So we see that a lot of that drive towards equity is investor driven. It comes from VCs. And that's why also we've now seen a lot of sort of these developer tool type of companies come out, because it's easier for them to raise. I think another interesting point is, like, I don't know if you start seeing this, that these are essentially protocol teams or layer 1 teams. They're not really business people, and it's far, far, far from ready from an enterprise to saying, okay, I'm going to base my infrastructure on it. So we're starting to see the first ideas of these protocol projects actually initiating a fundraise for a completely separate for-profit kind of equity company that just commercializes it. So I'd say kind of it would be more of a Ripple, but ideally kind of like a separate company that just makes easy software integrations and is actually very, very good at talking to banks and talking to large corporates. Have you guys seen any of that? Have you, for example, invested maybe in a layer 1 chain and now are funding like equity companies that are doing that on top, that are commercializing the protocol?
Seeing a lot of them, I think. I mean, there's a number of teams who are, kind of here, raising, talking about it. The model, I think, we saw it even as far back as, I don't even know, with Lightspeed, who was Stellar's kind of business team doing biz dev. They were raising like, what, year and a half, 2 years ago, something like that. We're seeing that model, I think, over and over. It'll be interesting to see the types of valuations that they come up with as a commercial company building services on top of like a public platform, because I think that investors will still hold them to the same types of metrics and same types of KPIs as everyone else, regardless of the fact that they're building on top of essentially their own platform. In my mind, it might even be harder for them to kind of achieve the types of valuations that they're looking for, just because they're sitting on arguably a gold mine of tokens.
Yeah,
it'll be interesting.
I think it's a good battleground. Like, does this underlying protocol actually really enable like a 10x, 100x improvement over something else? To be honest, one of the few cases I've seen is, for example, LivePeer. I don't know if it's like distributed video transcoding. So anyone in the world can transcode a video, which you need if you're live streaming a video. It needs to be adjusted to the format on my cell phone and for my bandwidth. That's computationally very, very expensive. And right now you can buy it for $150 from AWS for a stream for 24 hours. And just because they open it up in a protocol way that anybody could try, it turns out that some Bitcoin GPU miners that have these GPUs that can mine this for 37 cents. So imagine you going from $150 to 37 cents in electricity cost. So I think these are the first ones we're starting to see that we actually can see, wow, holy shit, there really is like this sort of ever promise, it's going to change the world, it's going to make things a lot better. And I think it makes sense to actually create semi-independent companies, maybe just some entrepreneurs come up and just take a spread, man. If I can charge like now $75 for it, and my cost base is going to be like maybe $1, that's going to be very, very profitable. So that's kind of our take. Then there's also the question, these ecosystem funds, does that work, or should it actually be attractive enough, the protocol, that independent kind of companies come up on it? Like, have you seen ecosystem funds really work?
No.
Yeah,
No.
Yeah.
It's kind of early, though.
Yeah, potentially. Yeah. I think that another question is like mercenaries versus missionaries. If you, and And this is something about software engineers or a few engineering professions. One of the few professions where the top 1% is really 20 times better than the 99% beneath it. And a little bit the concern is that if you have an ecosystem fund, you basically get mercenaries. That means it's going to be some enterprise developer who honestly is going to be in the lower end of that. And what you really need is you need to attract those 1%. They're not necessarily driven by money so much. One argument for equity is that, yeah, tokens, I have zero rights. I can't do anything. At least if I invest in equity, I have some control. Do you have any, have you experienced, for example, do you have any SAF token founder that really abused his ability to do anything? Someone pulled a shady move on you. Do you really have you experienced someone where a founder literally totally exercised that right to do whatever he wants? Because, yeah, we have some projects that raised $1 billion, and literally if they want to pay themselves out their personal dividends, they can. They have no shareholders, right? And do you have any experience with that? Do you really think that you have more rights and more control as an equity holder in practice?
So just adding on to the equity versus token thing, right? And I think there are a few paths that are gonna evolve. Say for instance, so I'm early investor in Zcash and Cosmos, and both token project, and they have a company behind it as well. So that's a very typical dual system. Zcash has a Zcash Foundation and has a Zcash company, and Cosmos has the Cosmos Interchain Foundation, and then also the Cosmos company. So that's the Tendermint. And so I think one potential path for all this at layer one, or just a general purpose protocol. And so if they have proved the viability of their protocol layer thing, and then so their backend companies so can actually raise independently, and then by doing traditional enterprise, so by enterprise software offering. And so that's a very that's especially true for Zcash and Cosmos, because they're very specialized in in their own domains, and that's one thing. So I think either is the equity towards token, or token towards equity, or just completely independent. That actually doesn't matter. And then talking about the governance, and so whether equity investment has more rights or token investment has more rights. And I think the answer gonna be twofold. And so if you are a token founder, or if you're token investor, and token founder is more so I would say it's a mayor of a mini city, right? And so it's more like a captain, and because you are just Vitalik, and he has no basically decision-making power for the whole Ethereum Foundation, but he has the influence, right? And so I think if you can lead without authority, so that is one of the primary quality of you being a good token founder. And it's the same thing for a token investor. So we as a token investor, and we always see us as congressmen or congresswomen, or just diplomats for the entire community. And so that's how you can influence the founding team, or just the core project members, and just the broader community. And even though there's no rights set in the terms, or just have anything as a constitution level thing. And I think different open source foundations have different decision making process, and just proposal making process. And so that's definitely a very big experiment thing for how to organize
I mean, also the original sort of ICO, the idea was that you raise an Ether, it's a smart contract, you issue an ERC20 tokens, your Ether are visible, everyone knows the wallet, and every move that goes out, the team makes a good effort to kind of document and sort of have some transparency. Obviously that doesn't work if you're creating a layer one chain and you're raising $20 million in cash, that kind of transparency is gone. I will say though that as an investor, it does feel nice that if you do equity investments, hey, here's a board resolution that approved actually the raises of our salaries, right? And so you actually have some transparency, whereas on token projects.
But the thing is at least for Valley and early stage equity investment does not have a lot, so does not come with a lot of very intrusive rights as well. So if you look at the most common terms, like it's say for instance, the safe, and safe is the like the origin of SAFT, right? Like if you look at the original safe term, and it's a very founder-friendly term. So I think the whole like ethos of like early stage investment is being founder-friendly, and so like there's definitely founders like gonna fuck you up, and so like, but like we rarely see any like class action, like any like lawsuit against the early stage founder. So I actually don't see like, so there's like probably like very bottom line. So if like the founders are scammers and like things like that, so you might be able to do something, but like the cost gonna be really high as well.
Yeah, and I think, I mean, in my experience, both equity and tokens, either way, if you have that bottom type founder that wants to scam you or escalate things, they can do that in equity or neither. So your legal recourse, you have some in equity, but in practice, it just turns out that you spend a lot of money to get probably like $20,000 back. And so it's kind of useless anyways.
I think in the seed stage, you really don't have that many rights anyway. Right?
It's trust-based. You have to choose the right people, and
it's involvement-based, I think, especially that your power of influence comes from your kind of initiative of getting involved and having the right relationship and really providing value to the founder. So for example, I'm an early investor in Parity. Well, back when it was called Ethcore, right? So I helped to angel Ethcore. I don't have many rights as an early investor, even though it's an equity. And I definitely don't have any rights as a Polkadot holder, who is follows that model of the kind of tech provider to Polkadot. But because of the relationship, you have a bit more inroads, you have a bit more kind of ways to kind of help guide things. So I think it's less about that at the seed stage. Maybe later in stages when you're in private equity, like larger rounds, D, E rounds like that, the structure and the governance and the rights take a bit more weight, and you can kind of exercise them. But people aren't really flexing their muscles at the season.
Yeah, and I think, I mean, yes, we can do that because we're full-time, professionally active in the space, and we have the network, and we spend time with these people. I think for the public sort of ICO funding type, I still think it's a potentially a great tool, but I think then you should ideally, and that was the original idea where you said, yes, it's safe enough for retail, normal people that don't have time to spend time with the founders, that they have some sort of structure like, okay, it's an open wallet, anyone can see what's going on, they have to sort of answer, or then sort of the ICO where things are paid out in tranches, if the team sort of token holders vote, like, okay, you've made enough progress, we give you more money. But I think for the very, very early stages, especially where, for 2 years you won't have a product, it seems to me that professional investors might be like, somewhat better at this.
Like let's say to be honest, and so like first of all, like this smart contract based fundraising is like, so it's not completely doable in like current Ethereum smart contract because so there's a lot of automation that like Ethereum smart contract cannot do, like based on like event driven or like time driven thing, and so like that's like the technicality part. And then second thing is, I think for most of the retail investors, many of them even don't know how to use that. So like many of them even don't know how to use the Explorer, and I really don't think that they have enough like just like know-how. Just like even though everything is on smart contract, it's a multi-sig wallet, blah blah blah, and I really don't think they have the competence and just had to basically trace everything by themselves. And then so if so like just like back to the basis of like crowdfunding, right? And so are you really going into this like nitty-gritty like detail of like what's the rights, like if you are putting money for like any like Kickstarter like pre-order, and just simply ask that question, right? And I think it depends on the amount of money. So people don't care what's going on, but like they care about their own investment, just like their like capital, right? So it depends on what's the amount of money, and if it's like $10, $20, it might be fine, but like if like anything go over like a few thousand, so like they can be a problem. And so like that's why I still think we should have like proper overarching like governance, and just overarching like governance, and from just a regulatory perspective, and just like to regulate this like crowdfunding like behavior.
And on the flip side as well, we're talking about token holders' rights, especially in more proof-of-stake networks where token holders actually have the right to govern certain things like development updates. I think there is more than token holders have more rights than you think, especially in like these open source networks. I've seen in smaller cap smaller cap coins where people accumulate very large positions of essentially like activist positions in one small cap coin and like threaten or blackmail the founders to, that they're
Now it's
the
interesting.
network.
Okay, now we're listening. Yeah.
So I think it goes both ways, right? Like you can't do that with equity, but you can do that in, I guess, a public market with tokens. And so I guess on the flip side, we see actual token holders have more rights than we might think.
All right, so there's indirect power, so you can basically threaten them that you're going to dump the price, or, all right, interesting. I do actually think also there is this sort of public pressure that teams are expected to be very public. They're supposed to be in the Discord and the Telegram. Anybody can say anything in there, so there is actually a lot of pressure on the founders, in my experience, from their community expectations. So I do think they really care about that. That sentiment of the community does affect them very deeply on a psychological level as well. So I think there are some sort of indirect kind of rights and ways to influence even as a sort of public token holder. Yeah, briefly maybe there was this whole expectation of security tokens are the new thing. I'll just ask you what happened to that before I give my opinion on that.
I think there was it was a bit cart before the horse. I think everybody was hoping that there would be another financial opportunity with a wave of security tokens, which hasn't really materialized. But the way that I always kind of think about it is it's not a wave, it's the ocean beneath where the real value is. I think that the eventual kind of tokenization of the entire kind of capital markets will eventually happen. Whether or not we're freely trading them through wallets or whether or not it's happening in the background, I do see that, we invested in Shares Post, which I think is doing a great job of trying to bring some of that as a licensed, platform by the SEC. But it's going to take a lot more time. So I was very bearish about it when everybody was, when there was a lot more hype around it. But literally in the last month, I've become slightly more excited about it, even here in Hong Kong, because we're starting to see, these real estate transactions come, a lot more of them. And what's been interesting is that the institutions, some of the larger real estate companies, some of the larger real estate conglomerates and investors are paying attention and actively engaging. They've been a lot more nimble than I've expected. One example, not on the tokenization side specifically, but here in Hong Kong, there's a government, semi-commercial government R&D arm called Astri. And they partnered with Bank of China as well as New World. Now, New World Development is Hong Kong's, one of, if not Hong Kong's largest kind of real estate conglomerate, multi-billion dollars, and they got together and did a real estate purchase platform blockchain-based, and it's a stone's throw away from tokenization. That kind of institutional adoption is interesting and could move the needle, and that's why I'm slightly more excited about it in the medium term, not the near term.
Yeah, yesterday I met with a project out of the EU that basically makes, it's an NFT out of Apple stocks, for example. It's live, it's on Ethereum. Anyone in the world except Americans can buy it with a whitelisted wallet address. Now I think there's still some challenges because for me the security token itself is not so interesting, but it's interesting what you can then do with the token, and you basically have access to the whole derivatives kind of decentralized finance space around Ethereum, right? So you could actually use that as collateral, for example, a maker. I think there's still a little bit of issues where, okay, right now you can only send it to another whitelisted Ethereum address that's KYC'd. But I think once you have identity solutions, maybe on a larger scale, that with attestations, okay, I'm not American and I'm over 18 and I can buy these things, that you can then also sort of enable these tokens to be used in smart contracts.
Yeah, so I'm a very commonly just a publicly known like bear for like STO because like security token is like just a security period, right? And the valuation for like security doesn't change, and like the playbook is all published by SEC. And so like that's why if you're an investor, and I recommend you don't invest in the security token itself, but like investing like potential like platform that will issue or just like trade security tokens, so that might be a viable path. And because for any just say asset, just as security token asset, like the underlying asset like either is a real estate or like art or like whatever, like just S&P 500, and then so you have the alternative channel like to buy the same asset underneath. And then also like right now, like the current problem I would say is like there's a clear like average selection, because like all these like premium asset, like say for instance like premium real estate or like premium jewelry or art, and like premium like stock, and so they already have existing marketplace or like existing channel, like where you can trade or buy or like transact like frictionless, and then so like that's why the current STO like marketplace or like channel like is kind of, you know, like very premature, and like there's just like no enough liquidity, and like there's a lot of promise of like global access like to access to like global liquidity pool is actually not proven at all. So like that's why like the so like the asset supply side, so it's like kind of like mediocre asset or just like just a B or C level asset, right? So like there's a clear average selection. So I see from the asset, so from just like simply from the supply side, and then demand side, and I think there's like definitely demand, and so like that's why like at the end of the day, ultimately in like 20 like 30 years, and so we should see all the assets going to be tokenized, but like now it's just way too early.
Yeah. Another question regarding token investments. There's you know, there's basically people got very enthusiastic about investing in tokens. Maybe they pulled the trigger very quickly. Now there's a bear market, they need money. So we hear of funds that are actually suing projects because they're not listing. So there's basically this dynamic that as a project, you say, I'm probably not going to list because how many people are really going to buy my token on the exchange? On the other hand, there's some investors that are really desperate for liquidity. And so, yeah, so the first question is like, have you heard this as well? What do you think about this? And yeah, should projects like actively decide when to list? Can they time the market? Or should they just like wait until we start having another bubble or something?
Yeah, I think we're seeing a lot of SAFs being traded on, I guess, closed networks for a fraction of the prices that they initially raised at. And I actually think that's positive for the market, because when you have more market valuations, it's a fair evaluation of what the project should actually be worth. And keep in mind, these are a lot of them projects that are waiting to launch as well. They're waiting for good times to launch. I think in terms of keeping projects accountable for when they launch, like that should still be like in the main roadmap. I think keeping projects accountable to when they intended to list or be listed in public markets, that's a bit of a tougher question, because keeping like market sentiment is actually quite important like for certain projects. But I do think that projects need to brave, I guess, the fear of listing and potentially not gaining market sentiment, because then to gain, I guess, a fair evaluation of what their projects should actually be trading at, even though to investors that might be not a very good sign that a project is going to be successful and it's going to deliver bad returns to us. I think it's overall to the ecosystem, like some projects that raise too much need to simply like start trading and receive a fair market valuation.
All right, thank you very much, everyone. That's it. Time's up, and thank you.